Please welcome Brad Triebsch.
Great, thank you, Kelly. Apologies, battling a cold if I sound a little hoarse. The Central Valley Fund, as Kelly mentioned, we are the first institutional capital ever focused on the Central Valley, and as such, I think many of our investors, when we got started, sort of viewed this as a science experiment, for lack of a better term, and was reminded of from the North San Joaquin Valley, a Turlock native and an old uncle in Stockton, who was a retired ship captain, got into farming, and went through some hard times, and said that he went to the war, was badly injured in the war, and came back, and his wife Lena tended to him and nursed him back to health, and then he said he was out working in the fields. It was a farm implement accident, and again he was badly injured, and Lena nursed him back to health. And then he said, he was laying in his bed, and he was on his deathbed. He looked over, and there was nursing him back to health. He looked over at Lena and said, "Lena, I'm beginning to think you're bad luck." That was sort of the environment that we entered, in the Valley when we first started. That institutional capital had been raised to invest in the Valley. There have been 3 early stage venture funds that were raised, and none of them were successful. So CalPERS, our lead investor, had not invested in the Valley since 1961, and when they did at that point, it was real estate related. So thankfully we were able to get the first fund launched, and in fact, was just comparing notes with Bill in the back room. I think it was about 10, 12 years ago we started, but the Central Valley Fund, we're currently on our second fund. We're a $120 million later stage venture fund, so we'll invest at break even or better, and focused on basic industry businesses primarily in the San Joaquin Valley. We can go throughout the western U.S., but our primary focus is the Valley. We have offices in Davis and Fresno, partner pretty close with UC Davis and Fresno State. Excuse me, our CVF1 first fund was $55 million in size, generated top quartile returns, and 5% for mezzanine debt, and I'll get into that a little bit better. So the takeaway here is that the Valley is investment grade, and despite all the socioeconomic indicators that we read about, and sort of the lack of sex appeal, and our companies don't have that scalability, or we may not be growing the next Google and Chowchilla, but our businesses we found here very solid, and primarily as a result of the dedicated work ethic that our entrepreneurs in the Valley have. Not because we've been in the latest gee whiz gadget, that's nice, but day in and day out, showing up 10 hours a day works wonders. Again, that's our geographic focus, is the Valley. Any given day, I'm anywhere between Lodi and Bakersfield, so a lot of windshield time, and again, the basic industry focus. We've established general criteria to identify potential opportunities. Typically, like companies around a couple years, 10 million in revenue, we're willing to go down to 3 or 5. And again, invest in companies that are break even. But what we really look for are referrals, specifically around the management team. We have seen great companies screwed up by bad management teams quickly, and we've seen poor companies turned around by good management teams quickly. So in the final analysis, we run a lot of models, but we invest in people. So the referrals, especially from our investor banks, are very helpful. And again, our investors are CalPERS, Wells Fargo, Rabobank, Union Bank, half a dozen Central Valley community banks up and down the valley, and then high net worth families. So Mission Bank locally is an investor. And we talked about geographic. geography. So in terms of the investment structure, here's how it works. We can do debt or equity, subordinated debt, preferred or common, 2 to 10 million in size. Typically the term is 5 to 7 years. And so whenever you're doing any, searching for any sort of capital, senior bank debt is the least expensive form of capital. You want to go out and load up on as much senior bank debt as possible. But oftentimes you have an opportunity, whether that is to acquire a competitor or you have an expansion opportunity that because you have increased business with Walmart or somebody else, and you need that extra slug of $5 to $7 million in capital. That's what a group like ours does. That we will come in and then provide either another layer of debt, what is known as subordinated debt, which sits behind the bank. And say if a bank will go up to, in terms of just lending on the cash flow, 2 to 1 debt to EBITDA. On a subordinated debt basis, folks like us will do 4 to 1. And then, you have to run the numbers and make sure that the company can sustain that. Beyond that, we'll invest in either what's called preferred or common equity, and that sort of, gets into the Sand Hill Road discussions you've heard about pre and post money valuations and sort of how much equity you're willing to give up. But the subordinated debt, I would say, is the most popular in the Valley. And again, the way it works is that it's a coupon or an interest rate of 10 to 12%. And then on top of that, we look for warrant coverage. And that is to say a small piece of the company, but always want to be minority investors. We never want to, own anything. And so if the company EBITDA comes in where, the company says it does, we can ratchet down to say 5% ownership. If not, we can ratchet up to say 20% ownership. But the beauty of the capital and the reason it's so popular in the Valley is that at the end of the term, which is 5 years, that we have the right to put that equity back to the company, and the company knows going in roughly what that cost of capital is. So for example, we invested in a Hispanic ice cream company in the North Valley. They had opportunity to get some additional business and needed to build a new freezer. The return on that equity was about 58%. Cost was in the mid-20s. But those are the kinds of examples. But we'll help you run the numbers. But it certainly has to make sense for both parties. But it certainly is a more expensive form of capital, but there when you need it. And again, I think of the biggest takeaway here today, and Kelly touched on it. It is about people. And again, we invest in, we don't ask for personal guarantees. We wrap ourselves around the character and integrity of the operator, the operating cash flows, and the business plan. So again, it's just people, people, people. And again, we sort of talked about it, but there's senior debt, which is a typical capital structure, lowest risk, lowest return. Equity is the highest risk and highest return. But again, if you have an opportunity, whether that be an intergenerational transfer where you're selling your business to the next generation, and you don't want to carry back the paper because sometimes if that second generation misses a payment, we have Thanksgiving coming up, and that payment gets missed around Thanksgiving, and Thanksgiving gets a little uncomfortable. A lot of attorneys and accountants will say, look, why don't you bring in some institutional capital like the Central Valley Fund, let them hold that paper, and then if there are missed payments, it's between the second generation and Central Valley Fund, not, Thanksgiving goes swimmingly. So, and there's the mezzanine capital that I talked about. So it's senior, and then the mezzanine sits on top of that, and then when you max out mezzanine capital, it's sort of 4 to 1 debt to EBITDA. Anything beyond that is equity in our business, and that equity carries more risk and thus more reward. So that's the reason for the higher returns, and it's completely unsecured, and that's how a capital structure works. This is a case study for a management buyout we put together. Excuse me, for a fertilizer company just north of Fresno. And so the legacy owners wanted to exit, wanted to sell it to the management team for managers bought the company. You can see the total proceeds. The one you want to note here and the takeaway, and this is again where our Central Valley is different, and you need to be able to be responsive to the market demands and market needs. In a typical management buyout, sort of case study 101, most private equity folks like us look for just 20% management contribution period. And if you can't do that, then you can't come to the table with a check, that they won't talk to you, or they'll come up with some sort of very roundabout way of trying to get to that 20%, which gives you very, very little equity in the transaction. Your goal is to buy the company. And we don't do that, and we understand that we do thorough due diligence, and really feel like we can get behind that management team. In this instance, these four managers who want to buy the company each came to the closing table with a check for about $100,000, and they went out and took a second on their house, and they were fully levered. And so we call that that we have parallel interests, or interests are aligned going into that transaction, which is to say, if the business goes down for whatever reason, that we know they're going to feel a lot of pain, as will we. And so you end up in situations. So for example, when Lehman fell, we, like many other firms, called all our companies and said, the world has changed, and we need to get together and sort of look at the expense side. We went down to see these guys. They had already taken salary cuts for the management team, canceled the janitorial service with cleaning their own toilets. You don't see that on Sand Hill Road. So, there are some regional differences. The deal support is critical, and this is a two-way street. If you're looking for an investment company, venture or other, to work with, that it's critically important that you do diligence on them. And so, for example, in our first fund, we did about a dozen investments. Almost half those CEOs are investors in our second fund, which we think is good testimony. But most importantly, go back and talk to CEOs that have worked with that investment fund, because it's not a banking relationship. It's more of a partnership where they're sitting on your board and offering some counsel and advice. And you want to make sure that when it comes time to exit, if that's what you want to do in 5 years, that you have a resource there that is, say if we're in the equity, we're going to lever up on everything we have to maximize the outcome for everybody. So, in other words, you just sort of want to get what you're paying for. And we think we can provide that. All of us have been CEOs and CFOs at successful operating companies, and that's important to walk a mile in the entrepreneur's shoes. So I would ask about that as well. But we've got a strong network. The financial reporting, is what I would say is the biggest challenge we face in the Valley. That the financial reporting that firms like ours require, audited statements, that sort of thing. Typically, for most firms, we look at, say, 20 million in revenues and a couple in EBITDA. That requires some sort of upgrade to the financial reporting, financial controls. So that is, if you're out looking for investment capital from institutional investors, you really want to make sure that you can present the financials, in very, very much an orderly fashion. If you have compiled, that's fine, but get a very cogent story together. But typically, we would like to see reviewed or audited. Would be ideal. We do have a deep and experienced management team. There are 3 of us operating partners who are out putting the road time in, but have over 25 years experience. And most importantly, you have to be able to increase the value of the business. And this is a public number, but invested in a municipal debt collection company in Fresno. It was a spin out from a large bond insurer back east, and we helped them buy it for about 8. They ended up selling it to a large public back east for over 30, and that was over the span of 4 years. So again, ask about the experience and you want to talk to other management teams that have made money with the investors. So the macro benefits, we're here to provide capital to Central Valley companies. We talked about the intergenerational transfer. 80% of our investments in our first fund were to women or minority-owned businesses or businesses located in a low to moderate income area. We're not a social sort of returns fund. Was not a stated fund goal, but by and large, that's what exists in the Valley. So de facto, we've got some social returns as well. This is a good quote from New York Times, and essentially, this is true. It's if you do get into a beef, and business, this happens, whether it's a wage and hour dispute or anything in California, every day is a challenge with the regulators. That chances are we've seen everything, and so it is sort of like you got your 6'4" linebacker brother sort of standing behind you to backstop things. We have all types of law firms and accounting firms and HR resources and networks that we can draw upon to help you solve business problems, and that's one of the advantages of private equity, and that's what you're paying for. Deal flow summary. Our average transaction size, this is actually over the last 10 years almost, but about 6.47 million. It has gone up since we first started. In our first fund, that number was about 3.3. The average company we see is about 26 in sales, 2 in EBITDA, and you can see the deals we've reviewed. We look at about 138 deals a year, and we close a couple. But just because we don't close a deal that year, I would say, and this is especially true in the Valley, as sort of culturally, that we can talk to a company in 1 year and close a deal 2 years later. And so just as, the best time to start talking to folks like us is when you don't need the capital. To establish the relationships, just like going out and talk to your banker. Go out and talk to your banker when you don't need the money. That would be my advice. And you can see the deals are evenly split in terms of sort of San Joaquin Valley and Sacramento. And a lot of basic industry is what we see. We see very little in the way of technology. Completed transactions, we've done everything from the guys that do the Jerry Garcia private label neckties to for lack of a better term, sort of colonoscopies are a sort of a gastrointestinal surgical center, very profitable business. To a horseshoe company. Our lead investor, CalPERS, was thrilled. They said, man, it doesn't get any more basic industry than that. And fertilizer companies, series of gas stations. A fellow in LA was expanding into the Valley. So the takeaway here is that you notice in 2009, there were no transactions at all. We looked at 130 deals, and everything we looked at had a lot of hair, and there was pressure to, obviously to get that capital out. So we literally did not do a deal, and apparently not uncommon in our business. And looking back at the crash. What's new? In Stockton, the San Joaquin Angels, early stage investors, made 10 investments. It's about 28 folks who get together on a quarterly basis and look at two companies. Two companies come in and pitch the group, and then they make early stage investments. That's pretty good pace of investing over the last 5 years. Again, we talked about our returns, and I talked to a reporter with The Economist magazine probably 2 months or so ago, and again another sort of piece on the Valley. And knock on wood, we've had some good news. I think the Lyle Center for Entrepreneurship in Fresno State, what Kelly's doing here, that there are a lot of good stories in the Valley. The Economist just didn't happen to print that. But despite what The Economist says, there are some good news stories. We think we're one that proving up the Valley is investment grade. We just held our 8th annual venture conference forum. We do it every year with Fresno State. We've done them up and down the Valley with UOP and Merced and others. but this year we had very fortunate to have Ronnie Lott to come and give the keynote. We've had other high-profile folks who have emotional connections to the Valley. Folks like Meg Whitman, Ronnie Lott, Warren Hellman, who arguably is the, sort of the Warren Buffett of the West Coast. And so people like the Valley, and especially like sort of the friendliness and the personal touch that doing business in the Valley provides. Today we're actually co-hosting with Wells and Price Waterhouse a food and beverage summit up in Modesto. And again, the Lott Center is ranked 8th in the country behind MIT, which is extraordinary. I mean, it's just sort of this gem sitting in Fresno. We have our first ever YPO group. Jim Damien, who you hear from later, is here as a member. We've got 33 members sort of up and down the Valley. And again, 10 years ago, our members had to go over the hill, either to LA or the Bay Area, to find a meeting. And now we have a San Joaquin Valley chapter where CEOs can, sort of, I don't have a board. I'm a member and sort of use that YPO group as, to bounce ideas. Excuse me. The Obama administration sent a White House economic SWAT team out here in July to examine deploying capital in underserved markets like the Valley. And we gave some testimony along those lines. And they say they care. We haven't seen any money, but they say they care. Conclusions, deal flow is solid and increasing. What we really need in the Valley is our, and events like this, are critical to ending this, but is our companies do not have what, companies in the Silicon Valley have, which is access to sort of a life cycle funding. So for example, they can go into an early, an early or a seed stage fund, receive that early stage funding, and then coming out of that, so that would, the Valley would be friends and family. Coming out of that, then you need that Series A or that institutional round. And that's what we're missing. We do not have an early stage Series A institutional fund focused on the Valley. And so many of our companies get that early stage capital, that sort of friends and family, and then can't get that Series A. Or they go to the Bay Area and get it, like Plastic Jungle in Fresno. This woman came up with a solution for the gift cards you receive, Home Depot, etc., and you throw them on the door. She came up with an online exchange as a way to trade these, and the idea took off, and she received $14 million in investment capital, and literally 9 days later, the company moved from Fresno to Redwood City. So, in the investment business, there's an old saying that the capital likes to be proximate to the investment, and in the Bay Area they joke that you don't want to cross a bridge to go visit that portfolio company. We joke we don't want to cross the main canal. But the point is that you do like to be close to that investment cap, and our studies have shown that the closer that capital is to that investment, the better that investment does. So to get an early stage fund to focus on Valley companies would be ideal, and you go from the Series A then to us, and we'll invest at break even or better, and then from us to a senior lender. That gives our Valley companies access to that life cycle funding, and we're just sort of missing that one gap right now. It gets it through they call it the Valley of Death. And the market education outreach is having an impact. I would say events like these, when we started 10, 12 years ago, we'd be lucky to get 20 folks. So very much appreciate the turnout today, and be happy to answer any questions.
Good time for one or two questions.
Yes.
Yeah, Brad, on these investment plays that you put together, are these all blind pools? And if so, do they have any limitations as to what the funds can be used for?
Sure. The investment length for say our second fund is 10 years. So we have 5 years to deploy the capital and 5 years to harvest it. And so once it's open to investment, it's then closed, and then we carry out the investment thesis. But it is pure capitalism. The profits are split 80% to investors, 20% to us. We receive our money on the back end in years 9 and 10 only after all the other investors have been repaid. So our money is truly at risk, and of that 120 we're investing a large, sizable amount of those monies ourselves. So when we cut a check, we're investing into the deal as well.
I did have another with somebody else. With reference to your investors, you referred to the banks.
Yeah.
But they're not equity investors, they are debt lenders, right?
Yeah, they invest equity capital in us, and they have something that's called a Community Reinvestment Act requirement. And so they invest in funds like ours, who are investing money in underserved markets. It serves a couple purposes. One, they can generate market returns, but two, it satisfies their CRA requirements under federal law. So, yeah, yes.
Are you, do you have much activity going on in Bakersfield or the Southern Valley area? Quite often we see programs like this and a lot of the activity stops at the present area. We're trying to see if we can get more activity on Bakersfield. Done much in Bakersfield?
Not as much as I'd like. That's one of the reasons I'm here. I mean, one of the only cities we have not planted a flag is Bakersfield, not for a lack of trying. We probably looked at, 15.
Everyone hear that question?
The question was, is there much activity in and around Bakersfield, and have we seen, sort of companies and made investments, et cetera? Because lots of the investment activity seems to stop at sort of the Fresno line. And I think the answer to that question is yes, that we would like to do more. We've looked at several Bakersfield transactions. We've not yet done one, got close on a couple, but events like this, and Kelly again is to be commended, that these go a long way towards just having a discussion around capital formation issues is just huge, because it's investment capital is sort of like the tetanus shot. You just don't know when you're going to need it, but at some point you're probably going to need it. And so you sort of figure out when that opportunity is right to make that connection. And then when you call me in 3 years and say, hey, I need $7 million, it's not sort of out of the blue, and we know you, we know your company. And so yeah, we'd love to do more. To answer your question, yes.
Last one.
On your first slide, you outlined your focus of manufacturing, distribution, and services. Does that services include professional services firm?
Yeah, the question is on the service category, do we invest in professional service firms as well? And the answer is yes. We've looked at doctor-owned radiology clinics and things of that sort. Great. Thank you very much.
Thank you, Brad.